Well, let's get across the market open now. Scott Phillips joining us from the Motley Fool. Scott, happy Friday to you. Reporting season continuing, of course. A couple of big results this week, particularly a focus on the banks, and the headline there being just how far those mortgage applications have fallen.
Yeah, mate, lots going on there. I mean, I will say, actually, before we get to that, the Commonwealth Bank profit was just phenomenally good. Look, only 7% growth, so, I'm not saying it's a spectacular number, but this is a very, very flat system with very little growth. The other banks are really struggling to grow. CBA grew its loan book and its deposit book faster than the rest of its compatriots. It just continues to get it done, mate. I was talking buying the shares, they're still expensive, but at a business performance, investors should be business analysts first and then valuers after that. And if you do that properly, look at CBA and go, you know what, in the market that it's in, given the challenges, given everything else that's going on, that result was a very, very good growth. So that's the first thing. Then the mortgage applications, mate, you mentioned, yes, absolutely. We've had all four banks now come out and talk to us about what they're seeing since budget night. ANZ, unfortunately, three of the big four banks talk about volumes. ANZ, they talk about the loan value. It's just a really muddy thing. So we'll start there because that was the smallest number. ANZ had a 12% decline in applications by value. The other big three, two at 15% declines, one at 20%. So big numbers in anyone's language. And then back to CBA, they gave us a little bit of extra information. This was important because they said their total applications around 15%. They did say that was starting to flatten a little bit. So maybe it's the big kind of initial shock and then things go back to normal. But they said investor loans were down 28%, almost double the overall rate of application declines. And no surprise, right? Because that's kind of exactly what the tax was designed to change, was the negative gearing benefits. What it does, though, to bank profits, that's going to be tough. Matt Commons said, effectively, it's going to be more competitive. Now, as consumers, that's great. As bank shareholders, that probably says more pressure on margins because the bank's going to have to fight harder and probably sharpen the proverbial pencil on those products. CBA's margin was down a touch, 3 basis points, not much. 2.05% the net interest margin. But yeah, it's going to be a fascinating story to watch. CBA absolutely head and shoulders above the rest. But I suspect if we do continue to see the ongoing decline of loan applications, remember, banks' inventory is money. If they can't lend it out or they're not lending out as much as they were, then that simply makes it harder for them to earn that margin on that money because they're simply not lending it out. So it's going to be an interesting one to watch. I don't know how this one nets out. No one knows what house prices do. And that's the other thing, mate. We talk about the value of applications. If that's compounded by a fall in the value of houses, so volume of applications, value of houses, that's kind of a double whammy, right? It feeds on itself, it compounds. So I don't know what will happen. I'm not a doom and gloomer, mate, so I don't know. No one knows. Don't listen to forecasts. No one's got any idea at all, other than to say the decline is meaningful, it's significant, it hasn't stopped yet. And so we can look at that and go, it's probable that unless something meaningful changes, those things will take a year, because we look at year-on-year numbers, to really net out properly, which might make this financial year a tougher one for the banks.
Scott, elsewhere, we got the largest telco in Telstra reporting yesterday, profit up. Look, obviously it's mobile business driving growth there. That's despite, of course, that national outage we had last month. Interestingly, obviously the headlines there around Vicky Brady's remuneration and the fact that they copped a bit of a hit as far as bonuses are concerned.
Yeah, I own a very small number of Telstra shareholder shares, just for the sake of full disclosure, Andrew. It was a decent result from Telstra, and again, I'm not giving them more credit than they deserve. If you're in a market, your job is to do the best you can in that market. Telstra's already the big gorilla. It's had nothing but share to lose since it was, since competition was enabled in the first place, when Optus first turned up, and so it's literally fighting every year to not have more share taken off it. So sales down 0.8%, not great, not terrible. Profit up between 2.7 and 4%, depending on which profit metric you look at. Again, in that scenario, in that market, that's a good result. Now, not a great result for investors necessarily, not a spectacular business. Just the reality is, if you're in the telco space and you're the big dog, that's what happens, right? So they've done pretty well, I think, to deliver what they've delivered. The challenge, however, is to grow that revenue, because yes, you can cut costs for a while. Telstra has been cutting costs effectively ever since it was privatised, and probably will continue to. But at some point, you've got to find a way to find some growth somewhere. And so that remains its challenge, to try and take back some of the share. Its issue is it's the premium player, and so it doesn't want to play on price. It's tried the second brand, the price fighter brand. That's a smart strategy. We know Qantas and Jetstar have done it actually pretty well. So that's probably the place you want to go and focus. You don't want jeopardize your really profitable business at higher margins to try and chase share. But if consumers are voting with their wallets, and we know what's happened with spending over the last 5 years, then it is a tough time to be a premium telco. Vicky Brady, as you say, $6.8 million she earned last year, up 11%. She'll be okay, but did lose $607,000 of her bonus because of the outage. The rest of the executive team had their bonuses cut by 10%. I mean, it gets kind of pretty populist and pretty, tabloid at some point as to how much is too much and how much not enough, and how much pain we want people to feel, and how much vengeance we want to, visit on people. The reality, I think, is what we hopefully know is this is going to hurt enough to make sure they don't make the same mistakes again. Is that going to happen? Anyone's guess. I've been saying about the banks since the Royal Commission, mate. Surely, finally, this is the last time we'll talk about this, and there's always another one. So, are the telcos finished with their outages? I doubt it. I would hope they're doing the work to make sure. They've now got a financial incentive to do so. Hopefully they get it done. But the result, pretty decent overall. Increase in the dividend, another buyback announced, another $1 billion. So capital management, obviously one of the key things if you're a slow-growing business, and Joshua putting some work and some money into that.
And Scott, Seek, look, there is intense focus on those online marketplaces, be it Seek, car sales, etc., particularly potentially the threat of AI. What did you make of its result?
You know what was the shares got absolutely smashed. The result was actually pretty good. The outlook was really soggy, and that's what investors were responding to. The idea of the job market softening. Now, as you rightly point out, mate, it's always hard when you see a single data point. You look at Seek, and other companies do it as well. They say, our sales are down or going to be down because the market is bad. Maya's been doing it about retail, for example, right? And that's always going to be partly true. But you never can until you see all the results from all the companies really work out how much is Maya and how much is the market, or in this case, how much is Seek and how much is the employment market. In other words, are they losing to competitors, or is the market itself genuinely the problem? I don't know with Seek, mate. I was surprised they were so bearish. I think what we might be seeing is, despite the fact that unemployment remains low, you have the same unemployment rate and everyone changes jobs in a given year, or no one changes jobs in a given year. The rate can be the same. The velocity of change, and remember, it's a classifieds business, right? This is how it makes its money. That's the key one. So if we're staying in our jobs longer, we're changing less frequently, less friction for companies, which is good for them, but less business for Seek, because we're not going to as much hiring going to replace those who are moving around. We're seeing it with wages as well. So I suspect that's probably at the core of this one. AI is going to be an issue. I think Seek's protected for a little while at least, because AI can only get its results from, generally, some sort of database of kind of record, if you like. And so where are you going to go? Yes, AI can look on company websites or LinkedIn or kind of aggregate, and they will do it, by the way. But if you're an employer and you want people to see your ad, you're going to have to put it somewhere where either the potential candidate finds it or some sort of AI aggregation finds it and actually displays it. So for a while at least, Seek will remain, I suspect, that place. Not the only one. Similar issues, as you mentioned, for other classifieds business marketplaces. Car sales, similarly. REA and domains, similar kind of challenges. Again, I think whatever the database of record, I think they've got some defense, but AI is incredibly quick and it's moving so fast. I doubt Seek's issues are AI caused. I absolutely believe they are working really hard internally to make sure they are building their defenses against that particular risk.
Scott, really quickly, I don't know whether you've had a chance to get across Baby Bunting out this morning, has lifted its pro forma net profit forecast there. What are you making of Baby Bunting at the moment?
Oh, this is so about discretionary retail, mate. This is one business that I had suspected, never recommended it to our members, thankfully, but I got really close because it was a really high-performing business. Whether it got over its skis, whether it was just more discretion than we thought, I don't know. Again, we'll probably know in the fullness of time. So they've been absolutely shellacked recently. The number's pretty good. Sales up 6.5%. Pro forma NPAT up 34%. EBITDA, they say, is pretty good, though they don't put the growth number on what I'm seeing here, so I suspect it's down. Look, it's a business that is hopefully going to bounce back for its shareholders. It is a category killer business. I was surprised to see it really struggle so significantly. As I said, probably more discretionary than I imagined it would be. So that's something for investors to keep in mind. In this current environment, though, in the situation where real wages are still going backwards, spending is still tough. If you're having a baby, you've probably got a high rent to pay or a new mortgage. So this is a really stretched consumer. So I've got to say, look, again, without looking deeply into the data, as I'll leave that caveat, mate. I may come back with a different view. Sales growth, pretty good. Some of that's going to be price, but some is volume. If they can get pro forma profit up 34%, they're going in the right direction. It's not, it's not solved yet. Dead cats bounce. If it falls hard enough, some sort of recovery is almost inevitable. So the question now, unfortunately, and always, is what happens next. But a pretty credible result. If you look at what's going on, I suspect it's pretty good. They call it the store of the future business, the new format stores. They say that sales growth was 18% up on the prior corresponding period in those newly refurbished stores. So companies are always going to spin. So again, I haven't looked deeply at the black and white financials, but they've done about as much as they could do, which is get up off the mat, try and show some positive results, some positive momentum, and I think they've probably done that from a look at these numbers.